Every year, there's a stock people say you're going to regret not buying. Today, I'm looking at one that they're calling on Reddit the steal of the century, and we're going to find out if that's actually true. Now, guys, this is not me saying this. I'm going to Reddit, and I love doing this. I love going out there and seeing which stocks people are talking about. And when I see headlines calling a stock the steal of the century, I automatically pause. Because here's what I know. That phrase is extremely powerful. It's very emotional, and it's designed to get your attention. What matters is not the headline. It's the numbers behind the business and the price you can pay for those numbers. In this video, I'm going to walk you through what this article says, and then we're going to run this stock through our principle-driven investing process. We're going to look at its price, then its value, and it's a story to see if this is just another hype headline or is Reddit right? Is this a rare opportunity hiding in plain sight? And I'll tell you what price that I'd be willing to pay for it based on my assumptions on the future. So you hear someone say a stock is the steal of the century. Sounds exciting. Like you're getting something amazing for super cheap, like buying an iPhone 17 Pro for $100. But here's the truth. That's just a phrase. It's marketing. It doesn't actually mean the stock is guaranteed to make you rich. It just means someone out there thinks it's really undervalued. History has shown us that sometimes what's presented like a great deal can end up being a total disaster. And I literally mean total disaster. Now, let me give you a few real life examples of when people thought they were getting amazing deals, but it all went downhill fast. First up, Enron. Now, guys, this was back in the late 90s and early 2000s. Everyone thought Enron was the present and future of energy. It was praised as one of the most innovative companies in the country. Fortune magazine even called it the gold standard. Analysts couldn't stop talking about it. The stock price hit over $90 per share, and people thought they were geniuses for owning it. But the truth was this. Enron was hiding a mountain of debt using off-the-books tricks. They made up fake partnerships to hide their losses and inflate profits. And whenever they made money, for 10 years in the future, they booked it all day one. It looked like a money-making machine from the outside, but it was built on lies. When it all came crashing down, the stock dropped to just 26 cents. Shareholders lost $74 billion. People went to jail. Literally all the executives went to jail. Next, Pets.com. Remember that sock puppet mascot? The huge brand recognition, the Super Bowl commercials? But the company was losing money on every single sale. They were selling things for far less than they cost to ship. That's not a business. That's a donation service. They went public at $11 a share, and less than a year later, the company shut down. Stockholders were left with pennies. Then you've got WorldCom. This is a giant in the telecom world. Investors thought it was undervalued and on its way to dominating the entire industry. They were buying up other companies left and right. But just like Enron, they were faking the numbers, about $11 billion worth. They hid expenses to make profits look much better than they actually were. The stock crashed. The company filed for one of the biggest bankruptcies in U.S. history. And again, shareholders got wiped out. Even Warren Buffett had a moment like this. He bought Berkshire Hathaway stock back in 1962, thinking it was a great deal because it was trading below its working capital. And this is something most people don't know. Berkshire Hathaway was a textile business. It was not started by Warren Buffett as a holding company. So in simple terms, he thought he could buy the whole company for less than its cash and inventory. But it turned out that the textile business was dying. He later called it, ironically, the dumbest stock he ever bought. Now, Buffett being Buffett, he used it as a shell corporation to build the greatest investment company ever. But that is the exception, not the rule. So what's the lesson? Well, just because something looks cheap doesn't mean it's a good deal. You have to understand what you're actually buying. What is the business model? How do they make money? What can go wrong? What's their balance sheet look like? Because we aren't buying lottery tickets. We're buying pieces of real businesses. And guess what? That takes discipline. And just because someone calls it a steal doesn't mean you should go buy it. In fact, if your first reaction is to go do that, then you're like me 25 years ago. The good news is, you don't need 25 years to get to this point. If you just follow these videos and follow this channel and you engage in our community, you are going to be there a lot faster than you think. So here's the article right now, and it's actually in the value investing subreddit. And guys, sometimes you will see me post inside the value investing subreddit and other subreddits of Reddit. The reason being is there are a lot of really smart people out there. Yes, there are a lot of morons out there who are just saying BS out there, but there are a lot of really smart people on Reddit. Now, guys, when I first read this, I was like, 110% revenue growth. I'm like, that's got to be a typo. And then I pulled up the financials. Well, I was wrong. 3.57 billion, same quarter the previous year, 1.75 billion. That was actually correct. I don't know how that is, but clearly they have seen a major increase in their revenue. This year's March quarter was significantly lower than 2024's March quarter, but wow, that's pretty impressive. Net income was up significant. Oh my gosh, everything was up. Well, okay, so here's the interesting part. Operating income was only up 19%, but net income was up from 175 million to 697 million. Let's see if there's a reason why. I mean, it was all revenue growth, because look at their SG&A expenses. Their sales general administrative expenses went from 623 million down to 552, even though revenue skyrocketed. That's going to really help out. But again, operating income was not much higher. And there's why also. They went from a loss, other income expenses was a loss of 211 million versus 350. That's another swing of $500 million. I mean, so that was underneath operating income. Now, going to slow down a bit because this is where a lot of new investors get tripped up, and I don't blame you. When I buy a company, I focus on one thing. All the stuff he said here could very well be 100% true. But guess what? Fast forward 10 years, there's going to be something else written here. Go back in time 10 years, also something written here. Let's go look at the chart here. Let's look at the 10-year chart on this company. I assure you, at this point right here, you could have written a huge article that involved a lot of things that were negative about the company and positive about the company. That's when it was $3 a share. It is currently $16 a share. This is why my philosophy is. I look at a company and say, do I think it'll be around for the foreseeable future, 20, 30 years? If so, am I virtually assured that the revenue and profit will be significantly higher in that 20 or 30 years than today? If the answer to that is yes, then right now I'd sit there and say, can I pay a reasonable price today that gives me a good, adequate return on my capital for that investment? Now you might sit there and say, well, Paul, that ignores a bunch of other things going on. You're right, because no company is perfect. Every company has issues. And very few issues in these large companies are actually detrimental to cause the company to go to zero. It rarely ever happens. Look at BlackBerry. BlackBerry is still around today. Guys, I assure you their cell phone business is down 99.5%. They're still around. Doesn't mean you should have bought it back in 2007. But you can't think of many times in history where a company gets completely wiped out because of a competitor on a grand scale of that magnitude. It's a very rare event. Doesn't mean it doesn't happen. It just means if you're always worried about that, to me, that's being too conservative. And if you're always looking at the most optimistic of situations, you're being too pie in the sky, head in the sky, kind of head in the clouds kind of believer. And I'm looking at going, those are two extremes. We've got to get back to the middle. And what's the middle? That there are good things and bad things happening at companies. I'm sure this guy is writing great things that are true, although a lot of people below are saying it's all AI. But either way, my question is, this is all great, but can I pay a reasonable price for the company today before I worry about these things? That is my process. And this is where a lot of investors get tripped up because someone on social media says a stock is a steal or it's terrible. It doesn't mean it actually is. I don't care this is a value investing channel. There are a lot of people out there who claim to be value investors and they go out there and buy Bitcoin. Sorry, you're not a value investor if you buy Bitcoin. Now, here are the basic principles you have to understand. Price is what you pay, value is what you get. That's it. That is the golden rule. And your goal should be to buy when price is below value. A stock is only a true steal if its price is below the value of the business behind it. So before you believe the hype, ask yourself, do I actually understand what this business is worth? Or am I just getting swept up in someone else's excitement? Investing isn't about headlines. It's about discipline, it's about logic, and it's about buying great businesses at great prices. Guys, the same way this article used this headline to suck you in, we did the same thing in our video. But it's here to teach that process of how to think. This is exactly why I teach on YouTube, because I started to see so many people, including all the bankers and investors that everybody said were so smart, attaching themselves to a story instead of to the numbers. It's a combination of story and numbers, guys. But if you had a gun to my head and said, believe only one thing, invest in only one thing, based on the kind of person I am, I'm investing in the numbers. Now, it's time to dig in. Let's analyze Nintendo, the everything money way. We're going to look at the fundamentals, the cash flow, and the long-term prospects. And more importantly, let's figure out what price makes sense for us to buy the company at using our stock analyzer tool. So let's go back to this main page. Key metrics: $77 billion market cap, $82 billion enterprise value. Now, guys, what's interesting is their 5-year average free cash flow is $2 billion. Last year, they did negative $44 million in free cash flow. But look at their net income, $2.38 billion versus $2.73 over the last 5 years. It's selling for 37 times 5-year free cash flow and 28 times their PE. So that metric doesn't, in and of itself, doesn't make it seem like it's a steal. Guys, and for you, those of you who don't know, Nintendo actually started in the 1880s as a playing card business and then got into toys and things like that. So a lot of people think Nintendo just started with their console. Not true at all. In fact, it's in Japan. If you go look at the list of the oldest companies that still exist today, a huge number in Japan. Like literally there are companies from like 800 AD that are still around today, construction businesses. I mean, look at a company like Warren Buffett, Berkshire Hathaway, and Buffett said the other day, I think Berkshire has the best chance of being around 100 years from now out of any company I know out there. They're talking about 100 years. These companies were started 1,500, 1,200 years ago and they're still around today. It's absolutely incredible. All right, guys, so here's a simple story. Every time Nintendo launches a new console, sales explode, obviously. And the new Switch 2 is no different. It sold over 5 million units in its first month, beating the original Switch launch by over 70% and lifting the whole gaming market with it. Back in 2017, the original Switch turned things around for Nintendo after the flop of the Wii U, eventually selling over 150 million units. Now with the Switch 2, Nintendo is doing it again, breaking records, raising forecasts, and pulling ahead of PlayStation and Xbox. So what's the bottom line? New Nintendo consoles equals big demand, equals big sales, and a big boost to the whole gaming industry. But that's temporary. It's not this long-term, every single month and quarter is going to be exactly the same. So now let's look at the cycle of Nintendo console sales. So as you can tell from this is the console sales over time. Big jump, drop, big jump, drop, big jump, drop. Why? Because a new console is going to spark a ton of sales. And that's what drives a lot of this revenue increase, the 110% we talked about before. So guys, if you look here at consoles versus games sold, what I was saying earlier, when they sell a console, they don't mind losing a little bit of money if they have to. The original Nintendo, 62 million consoles sold, 500 million games. Game Boy, not as good, 120 million versus 500, 49 million versus 379, 154 versus 950, and it goes on. Guys, look at this one. The 2017 Nintendo Switch, 140 million units, 1.2 billion games sold. So guys, here's the revenue here on the left, expenses here on the right with the gross profit, operating profit, and net profit here at the top. You sit here and look at this and you have a gross profit of 61%. That's pretty high. Those games are so incredibly profitable. They just churn them out. And nowadays, you're doing a lot versus download. You don't even need to make the chips or any of those things. Now, guys, this is the world of AI. Nintendo is actually apprehensive about AI. Their comment is, and it's a very Japanese culture comment, which I love, is that, guys, we have amazing confidence in our developers. We're not going to be here to rely on AI. We're going to be here to rely on our developers. Now, that's an easy thing to say right now. I guarantee you, if you go back in time in 2000, you'll see people say, guys, we believe in our salespeople. We believe in our staff. We're not going to go to the internet because we believe in providing value that way. Maybe it sticks. Maybe it doesn't. To me, AI is just another tool to be used in the world of development. It doesn't eliminate completely people. And you might sit there and say, well, yeah, Paul, it kind of is. I actually don't think that'll be the case. When I go to a website, I need customer service. You know what I can't stand? When I get AI. I still want that customer interaction. Now, AI is still in its infancy, so it might get way better in the future. I have companies that have everything money. We have actual people responding to comments between normal business hours. All of my real estate, we have real people answering questions as much as possible. Why? Because people still want to interact with people. Doesn't mean AI is not going to change the world. It does mean, though, that maybe Nintendo is onto something with their development. Doesn't mean they're going to eliminate completely, but they're still going to rely on their developers to help be enhanced with artificial intelligence, in my opinion. So they paid dividends of $1.2 billion last year, which they really couldn't afford, but they probably used their cash up front there. Let's look at their 8 pillars. Not great. Very low long-term debt. That's pretty awesome. good returns on capital, almost 20%. So this is a premium business, and I'm not worried about the cash flow being down. I'm worried about the revenue being down. I'm wondering how volatile these revenue numbers are. To go up 110% in 1 year over year, that's a big, big jump. Now, before we run the stock analyzer tool, I want you guys to remember something. Most investors lose money because they're trying to pick the next biggest winner. The best investors do the opposite. They eliminate the losers first. That's what we're trying to do here when we analyze a company. The company might be a great story, but it'll be a loser if you pay the wrong price. That's the big key there. Or it could be a loser because the business just sucks. That's a very logical statement as well. There are many ways in which a company becomes a loser, but the one that everybody screws up the most is the one that they ignore the most. Price versus value. That is the biggest way in which people lose money. They find a great company and they pay the wrong price. So how do we pay the right price? Well, guys, this is where Stock Analyzer tool comes in. Take the story, we take the numbers, we put them together. We make assumptions about the future. Now, I will say, it's harder. I'm a little apprehensive because I see 110% revenue growth year over year. And I'm like, what's the right number to put in? It's not like Microsoft where it's like, 10 to 15% revenue growth pretty consistently. So let's make some other assumptions about the future. Let's do revenue growth of 5, 8, and 11%. Let's do profit margin of 20, 23, and 26. I'm going to do the same thing for free cash flow. Even though it's been very different lately, over long periods of time, it'll probably equate out. And by the way, guys, maybe that free cash flow is down because they sold these units at a loss. I don't know. I'll have to look that up. Now, what PE should this company get? Well, guys, 10-year return on capital is 15%, 5 years, 20%. So it's growing here. Let's go with 16, 19, and 22. And then finally, my 9% market desired return. What I'm trying to do here is get the value of the business, not my price, the market price for it by matching the market return. The stock is currently at $16 per share. I hit the analyze button. I have made every possible investing mistake you can imagine. I bought too high, I sold too early, I listened to the wrong people, and that's exactly why I built Everything Money. It was first built purely for me. I wanted the tools that gave me clarity and decreased the fear of investing. People saw me using these tools on YouTube and said, Paul, can you share those? And at first I said, no, it's a data feed. But then I realized I could make this. So I did. And the real community was born. Real people sharing ideas, live chats, live streams, and tools that help you beat 99% of investors, but most importantly, help you sleep better at night because money can be very scary. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator. So stop guessing, start learning, start sleeping better. Try it for $7 for 7 days. I'll see you in there. So guys, the stock, hit the analyze button. Stock's currently at $16.50. I have a low price of 6, a high price of 15, a middle price of 9. I don't see the steal of the century here. That's my opinion. He's probably making assumptions about the future, maybe that are story driven and not numbers driven. At the end of the day, every investment you make, your return's gonna be based on all the cash flow you receive in the future. If the story is great, but the cash flow doesn't match, it's a problem. If you pay too high a price, it's a problem. Now guys, earlier this year, I picked my own Magnificent 7 stocks to go head to head with the market's actual Magnificent 7. Click the video on your screen to see which stocks I picked. But guys, I did not pick them just for 1 year or 3 months or 6 months. I said these stocks will likely beat the actual Magnificent 7 over the next 10 years. So check out the video, see how they stacked up, because the results might surprise you. Thank you for your time.